Good morning and welcome to the Rethink Labs webinar on digital asset allocation. I'm your host. My name is Eric Geisels. I'm the research director of the Rethink Labs at the Keene Institute. I'm a professor of finance at the Keene and Flagler Business School and a professor of economics at UNC Chapel Hill. This is our first fall event and we are off to a great start. The topic of digital asset allocation is a really great topic and goes way beyond just the question about portfolio management. And there is no person better placed to talk about this topic than my guest today, Zoe Cruz. From 2005 till the end of 2007, she was the co-president of Morgan Stanley. She joined the firm in '82 and became the co-head for the firm's foreign exchange business in '93 and global head for fixed income, foreign exchange and commodities in 2001. After her distinguished 25-year-long career at Morgan Stanley, she built her own boutique investment firm focusing on global investments across two funds. She is currently the senior strategic advisor for the blockchain fintech company Ripple, and she also serves on the board of the Man Group. Of course, Ripple has, over the past few years, provided generous support for research on blockchain technology across a very wide and international network of universities around, including UNC Chapel Hill. Thanks to the generous support of Ripple, we have built here at the Keene Institute a very active research network on fintech. I'd like to say a few things about housekeeping. At the bottom of your screen, there is a Q&A tab. Please feel free to write questions during my conversation with Zoe, and we will set time aside at the end of this hour to answer some of your questions. Zoe, welcome. It's a pleasure to talk to you this morning, and thanks for accepting our invitation. My first question is kind of the obvious one, perhaps. You've spent such a long and distinguished career in sort of quote-unquote the traditional established finance world, and you sort of made the switch to the crypto world. I'm curious, tell us a little bit how that happened and what made you decide to do that switch.
Yeah. Well, as is the case with most things in life, being in the right place at the right time and accidental discoveries. And I would say the reason I was intrigued by that world where a new and important technological innovation occurred, which is blockchain technology, right, distributed ledger technology, is because I grew up, as you mentioned, in the foreign exchange world. But the foreign exchange world I entered, which is the ultimate macro world, FX, as you know, is a truly global business. I was a Romance languages and literature major in college, and this for your audience will be very important to hear. And so I basically interviewed at a bank in Boston, and the HR department said, "Oh my God, you speak 4 languages. We have an opening in foreign exchange." So of course she had no clue you don't need 4 languages to trade foreign exchange. Right. So my introduction to the global macro world was completely accidental, but I had a front seat at a world that was globalizing. We're talking about late 70s, early 80s, where the construct that we're going to talk about, the last 3 decades of that construct, was freely floating exchange rates. Capital was free to move around the globe for the highest return. Labor was not, and that has a bearing later. And so when you think about, I joined Morgan Stanley out of business school in 1982. It was a private company. it had 2,000 employees and 3 offices. When I left in '07, it was 60,000 people, 60, and it had offices everywhere in the globe. So you talk about, you just get on that escalator to the moon, if you will. Being in the right place at the right time matters. Of course, you need to do a decent job. So fast forward to how I entered this business. As I was approached for board positions, most of them were to be a board member of major global commercial banks. And I said, I've been there, I've done that, I have zero interest. I want funky new ideas. So when the headhunter called about Ripple, I said, I like the blockchain technology part of this, but this crypto world, Bitcoin, I don't really believe in that stuff. And I'm glad I took the call and I met the executives at Ripple. And so I got into it, as I said, by accident, but I knew enough from my macro background to know this was something big. It was something new, and it could still have binary outcomes. It could end up at 0. I don't think so, but the possibility is not 0. But I feel it's as big an innovation, and it's as big a new thing as globalized finance was in the early 80s.
Great, yeah, indeed. I like your multi-language story because I'm from a small country, Belgium, and I speak 4 languages because I was surrounded by big countries that spoke different languages. So I like that foreign exchange. So, the title is Digital Asset Allocation. So let's start with perhaps the portfolio manager. There's bigger things to be talked about, but let's talk about the portfolio manager first. And how would you, as an investor, think about adding crypto currencies to your portfolio? What's your thought on that? What would you sort of advise people who want to sort of dip into this? What would you like them to do?
I would look at 2 reasons, compelling reasons why you want to look at this space, whether you're risk averse or you have more risk appetite. One reason is the current 60-40 portfolio, again, that I made my career, 60-40, 40-60. You could talk a lot about the micro, but it was the macro bet that made you the money. When you think of that world, again, when I left business school, 30-year treasuries were at 14%. Risk-free rate of return was 14%. And so half of your portfolio, we engaged in the ensuing couple of decades in the biggest bull market in fixed income in my generation. And so, again, you didn't need to be a rocket scientist to actually put half of your portfolio into that asset class and ride that to the moon. When you talk about $80 trillion worth of fixed income assets right now, with the portfolios that need to be allocated, $80 trillion, 14 trillion of that is at negative interest rates, not 14% negative. Never mind, so that's the risk-free rate of return. And the balance is oscillating above 0. So half of your portfolio that contributed to low double digits, high single digit returns is not going to do that, to state the obvious. And in fact, I did some work that says for it to contribute equivalent amounts, rates have to go to minus 22%. Well, we know that's not going to happen. The other 60% or 0.5% of your portfolio, I think even the bulls would say it's expensive. But to me, the data points are beyond it's expensive. Tesla trading at 800 P multiples. NASDAQ, as an example of, there are a lot of good things that are going on in the technology sector. But I actually think, again, in the pre-08 crisis, people forget that people lost their jobs being negative on mortgages. They lost their jobs and their careers because they were negative in 05 and 06. Because 07, equity markets were still making new highs. So my question is this 05, 06, 07, I don't know, but I know it's one of these 3 years. Mm-hmm. And so coming back to the crypto world, it's desperation of how you're going to preserve capital that should drive you into some other things. And gold, real assets, to state the obvious, would be some of those things. And then cryptocurrencies I look at cryptocurrencies not like looking at correlations and is it negatively correlated to the traditional portfolio and should you have it in or not. That's not a relevant calculus. To me, Bitcoin is the oldest cryptocurrency. It's 11 years old. It actually started being a legitimate asset for investment in 2014, 15. I don't know what data you'd be looking at that's relevant to that. So I look at those crypto investments, and I believe in diversified investments as moonshot opportunities where your investment could go to zero, or you could make 100x if that world continues to grow. So with moonshot opportunities, as you know, you don't want to put your kids' education on the line, but it is rational. It is rational to actually have 1 to 5%. And if you really believe in the stagflation environment, 10% maybe, into that world, but not just Bitcoin and not just XRP, but the top contenders.
Yeah, that leads me to my next question, actually. So, I mean, we do talk a little bit about, you talked so far about cryptocurrencies as an asset class, but we know that, I mean, there are, I would say, zillions of cryptocurrencies around. And so, I mean, the obvious one is everybody talks about Bitcoin, but there is Ether, there is Ripple, XRP, so are you, when you diversify, because some might have, I mean, I think most people would agree that Bitcoin is kind of the lead example, but may not be the only one. And so are you also thinking about diversifying within that group, or are you sticking to one?
So diversifying within that group. So the first step is a two-step diversification. First step, diversifying from traditional asset classes.
Right.
And then the second, once you decide what is your risk profile, whether it's 3% or 10%, it doesn't matter, diversify within that asset class of the top 5 to 10 crypto assets, cryptocurrencies. And to me, saying I'm only going to put Bitcoin, I'm only going to invest in Bitcoin because it's the current winner, or the digital gold, as they call it, is equivalent to say that in the early 2000s, you're only going to invest in one internet stock. And I don't need to tell you whether it's social media, Facebook didn't exist by and large. I mean, Netscape was the browser of choice with 75% market share. Right. Google is the leader now, and Netscape doesn't exist. So to me, it's the equivalent thing. I don't know, there will be winners and losers, but I wouldn't want to have Bitcoin end up being the Netscape of your investment opportunity. And again, the way I look at that diversification, each of those currencies was designed differently. It has underbellies, all of them do, but it also has clear winner characteristics in the alley that they chose to compete in. So Bitcoin is the digital gold. So when I talk about diversifying, it's the idiosyncratic risk of that particular cryptocurrency. So the pluses and the minuses of Bitcoin, digital gold, the oldest, it made a lot of people rich. So you have a lot of passionate people that would, be very good at defending it and its construct. Its underbelly is actually, it costs a lot of energy. And I don't need to tell you, ESG, environment, social governance, is the new thing. The bigger the blocks, the more successful Bitcoin becomes, the more that's an issue. XRP is the ally it has chosen, and it is the leader in that class, is basically the cross-border payment system. The reason this is an important distinction is cross-border payment system currently practiced through correspondent banks works fine through the SWIFT system. It's a messaging system. It works fine. If you're Morgan Stanley sending $1 billion to Goldman Sachs or to Citigroup, if you're a small basket weaver in Nigeria, not so good. So the cross-border payment system, where XRP was designed for rapid, literally instantaneous, nanosecond transaction time for very high volume, low value business, where you can send $200 to the woman in Nigeria, that's an idiosyncratic plus. Its minus is it has a lot of concentrated holdings in Ripple, the place I advise, where 50% of all the coins minted are on the balance sheet. So again, Ethereum. Ethereum is a very successful currency. Its ally is smart contracts. There are a lot of very smart people actually coding and doing a lot of building beautiful things on smart contracts on Ethereum. So I would look at these currencies as a VC investment, a surrogate for a VC venture capital investment, without the fees and without the intermediaries. And as you know from VC investments, you're very, very good if you have 2 moonshots and 8 of them go to nothing. So that's how I view that world.
I like that actually, because indeed, those 3 examples, Ether, Bitcoin, and XRP are basically very different in fundamentals. The business model for those 3 currencies is very different. And the diversification makes a lot of sense. Now, you kind of dropped the word gold, and this is perhaps a little bit of a transition from sort of the discussion about moonshots and sort of betting on growth, potential growth. It gets you into the discussions of macro risk. Gold is often sort of, or historically viewed as the hedge against for bad times. And there's been sort of arguments that Bitcoin is the new gold. It's sort of the go-to assets when there is a downside risk. What's your thought on that? Is Bitcoin, particularly Bitcoin, the new gold, or would you shy away from that statement?
No, not at all. Yes, in fact, as I said earlier, in its design and its the way it has a passionate group of people who will preserve its value, because the more you have vested interest, the more you will try to preserve its value. But that actually doesn't say, to me, I invested my own personal wealth and others. Asset allocation was how I made my career. I never owned gold up until last year, because I don't believe in negative carry investments, which gold is. But something big in the macro world, so they're not mutually exclusive things. They're not either you invest in Bitcoin or you invest in gold. You invest in both for different reasons. For me, gold when you are talking about, we've all of us lost actually a sense of what is egregious and what is, me included. To me, we're printing money in the trillions with an S, trillions. We have a Republican government that is printing more with a $3 trillion budget deficit and interest rates at 0.
Right.
So they're pushing on a string here. And so I feel, and I'm doing a lot of reading on the Weimar Republic, where the Deutschmark was good, and then it wasn't. And it wasn't good by a lot. And so for me, gold has a very real place in a world that's falling apart. I think stagflation is a very real scenario. And people are very US focused because, I mean, India and China, I would argue, is already in a stagflation environment. They both have inflation and their economies aren't growing. In the US, I feel we have measurement issues with the way we measure inflation, but the purchasing power of your average middle-class American, never mind lower middle-class American, where the food and rent is where they spend half of their disposable income, for them, inflation isn't 1.6% if you went to the supermarket lately. So we are going to have, I believe, a stagflation world where you should have gold more than you ever felt comfortable, because for me, a lot of portfolio managers with fiduciary responsibilities think that I want to be risk averse. But in this environment, the ultimate risk is not taking any risk at all. That's the new thing. The fact that you're piling in to 30-year money at 1%, to me, that's the ultimate risk that you put in your portfolio to.
Your mentioning of the Weimar Republic is scary. I'm sorry. And I'll tell you an anecdote why. When I was an undergraduate, I had a fairly old gentleman who lived through the German hyperinflation when he was himself a youngster. And he told the story that people would go to a bar at night and order all the beer for their entire night at the beginning of the night, because by the end of the night, the beer was substantially more expensive. But anyway, that's hyperinflations, of course. And note that the Fed itself, I mean, we've had this 2% sort of target for inflation, but lately, we all know that the Fed, they've sort of now said, well, we'll kind of say on average or relax this a little bit. It's not so too bad about having a little bit of inflation, and so it's coming. I agree with that, actually. Anyway, so I see a little bit back to the cryptocurrency. All your arguments are very compelling, but there is still the kind of world of institutional investors out there who are probably conservative in their asset allocation. I mean, there's also the issue that Bitcoin has a little bit of a shady side to it. It's being used also by organized crime and things alike. So where do you see, the majority of institutional investors are staying away from digital assets.
Yes.
What would it take them? What do you think it will take for them to be convinced? We have options markets now.
Yes.
That's added to the equation, but it probably will take more than that. So what's your thought on that? What's going to move it?
It's a great question. And I think that unless the industry, with the help of global regulators, create a framework, a regulatory framework to subsume the black hats, the drug lords, if you will, and have regulatory robustness where the white hats, and to me, Fidelity is the white hat, the drug lord is the black hat, all is lost. So my bet, and Ripple I know is has a leadership position in trying to get rules of engagement that make sense. Having come from Wall Street, I believe they are right to throw the opprobrium that they've thrown at our industry. We contributed a lot to mindless deregulation, and we forgot actually, and I intend to help the industry not forget that the Glass-Steagall Act, which was 35 pages long, which actually was the result of the last great crash in the 20s,
Correct.
was born out of that crash. It took decades of good regulatory frameworks to create the biggest, most liquid market in the world called the US equity market. What did we do with that 35-page principle-based regulation, the industry, where Glass-Steagall had a very simple principle. You could not be a principal and an agent to the same transaction. That's unacceptable conflict. Very simple. Well, we threw it out the window, and well, we all know what happened after that. So now we have mindless regulation, which is the other extreme. I'm not talking about having mindless regulation in this industry, but I think if we coalesce around principle-based rules, which I think the Europeans ironically are better than the US at this, I think we will save the industry from the drug lords, but not completely. Cash is the favorite means. It's not Bitcoin yet, it's cash in suitcases on private planes that gets the drug lords money from one place to another. So you're not going to eradicate that.
Yeah, I mean, you're touching on so many topics right now, regulatory issues. And I mean, there's also the conversation about currencies. Some central banks, including the Chinese central bank, and others around the world are experimenting or implementing even basically digital substitutes for cash. In particular in China, where there is much more use of mobile payment apps, which sort of is widespread. And now we're talking about the world of transactions, the payment systems, and the regulatory environment and monetary policy. We're getting back to inflation and fiat money. So where do you see this going in terms of, and that is part of the moonshot as well. I mean, XRP is making interbank transactions, international transactions easy through blockchain. What about the more widespread blockchain payment systems that central banks are experimenting with?
Right.
What's your thought on that?
So I think that it is a good thing that the central banks around the world are saying there is technology that can help us become more efficient in moving fiat currencies around. If we make them digital, we can use the technology to make the world more efficient, where we don't need the Citigroups, the conglomerates. As you know, they have a lock on global movements of money. If you're going to say antitrust is going to be the new thing, I need to get the intermediaries out of the way by actually having the digital world be helped, helping the monetary fiat currencies. Money, fiat currencies, whether it's digital or cash, will never go away. I believe that there are two very powerful monetary policies for any sovereign nation, fiscal and monetary policy. They will never give up control of that. What they've done, though, is say, crypto to crypto, knock your socks off. If you want to basically agree, because remember, Bitcoin was created to bypass, to not have fiat currencies be necessary. So it's basically being able to do barter economy using the Bitcoin as a bridge currency or XRP as a bridge currency. What they've said is Crypto to crypto, knock your socks off. You want to lose all your money, be my guest. Where they're very keen, and I think they will win that game, is the on and off ramps of fiat to crypto and crypto to fiat.
Right.
And that's where I feel, again, the industry is a bit conflicted because it's noise. I mean, remember, you have the Bitcoin enthusiasts that created, these brilliant people that created Bitcoin, as I said, in '08, out of the ashes on Wall Street to fight the man. Those guys are never going to accept fiat currencies, but they're not relevant in the world I'm talking about in terms of having Fidelity diversify its portfolio. That revolutionary is not relevant. The relevance is, are these usage cases real? Are they scalable? And who are going to be the winners? Because the winners in that space, the mode of actually transacting in that alley is the currency. So it's a cheap, effective way, as I said, to actually bet on this future.
So the other one everybody talks about is Libra.
Mm-hmm.
So Bitcoin, Ether, XRP, etc. They're all grassroots. They started out by private enterprise initiatives or grassroots initiatives.
Mm-hmm.
And then we talked about central banks and we talked about monetary policy. But now we're back to Libra, which is basically Facebook. So where do you see this going in terms of this? Is it going to be ultimately something different, not much different from a dollar? And as I sometimes say to my students, we replace "In God We Trust," which is printed on the dollar, in cryptography we trust. So is it going to be mostly that, a replacement with a sort of an official central bank backing, or are we talking, as we currently have, mostly either private companies or grassroots sort of initiatives? What's your thought?
The answer is, I don't know where it ends up, but I know how why they're pivoting. Because remember, Libra 1.0 was dead on arrival. Right. It had great technology. You're talking about Facebook distribution. Clients around the world of 2 billion people. I mean, what an amazing beginning of a story. What they got wrong, again, is if you're going to pretend you're going to play in the banking space, you need to understand that construct. So you can say that whatever fancy name you call Libra, it's actually digital fiat currency you're playing with. And if you're going to be in a digital fiat currency, I'm going to regulate you the way I regulate Citigroup. Citigroup is run by people that understand what the regulators want nowadays anyway, and process. So they pivoted to something where they understand they need to accede to regulators' concerns. And therefore, I think they have a chance at succeeding. But then, because I have a lot of respect, obviously, for both the technology, their intelligence in knowing where they need to go, but I think they don't really understand the heavily regulated financial world that has become a utility, which is what they've said to the top 10 global banks. You can actually have 80% market share, but you're going to act as a utility. I'm going to be all over you. And if Libra is willing to submit itself to that, they can play that game. Right. But they need to reinvent their business model. And then the final thing I would say, if I'm a betting person, antitrust is going to be a very big theme. If I'm interested in law, what I would tell my students is study antitrust. These global behemoths, I don't think they're going to be allowed to function the way they're functioning, which is hoovering everything into a big dark hole at the center.
I agree. I want to talk to you a little bit, get you back to, you've done 25 years with Morgan Stanley in quote unquote established finance or traditional finance. And we started out talking about fixed income, foreign exchange, commodities, usual asset classes. And now we have private equity, which is sort of off the markets. But there is, particularly when you talk about Ether and Ethereum, sort of this programmable part, the smart contract part of the blockchain. And not just for the purpose of currencies, but initial coin offerings and the like, which is totally a different conversation also in terms of regulatory environment. The SEC has had some opinions about that. But if you sort of think about blockchain technology penetrating into the different asset classes, such as collateral markets, what's your, so this takes us a little bit away from the currency discussion.
Right.
Where do you see that blockchain revolution, which is now also sort of penetrating in contracts designs, where do you see that having an impact in the financial world?
I think, well, first it will have an impact in the way we live, in the sense that smart contracts, identity and smart contracts, meaning right now, if I sell my home, I actually have to go into a physical file and find that piece of paper, the deed, that says I own it. In the 21st century, well, the first thing that's going to be revolutionized is you're going to have immutable records, thanks to this blockchain technology, that'll make our life a lot easier. In terms of the financial aspects of it, again, the old finance that I belong in, billions of dollars at Morgan Stanley are being spent on operations and technology that is, a hodgepodge of old systems, trying to talk to one another. This is tabula rasa and says you don't need all this operational chaos that is part of the old world. That, to me, blockchain technology will make not only the collateralized loans any security, whether it's equities, whether it's even the more complex. They cannot be too complex, because then, automating very complex things that require more than 3-4 factors, that's not, but there is a lot of room to make moving asset value around a lot cheaper without as many intermediaries taking their 2%.
Correct. We were kind of winding down, but I sort of wanted to, given your long career, in the finance world and continuing in the crypto world. So last week I read an article, and this is not the only thing that you read about it, but the Financial Times, it's my morning reading, my Financial Times breakfast reading, that for this year at least, all female or mixed gender portfolio management teams are outperforming all male portfolio management teams. So as a woman in this industry with a long career, any comment, any thoughts, either rational or emotional?
Well, look, I actually am a huge believer in diverse teams, not all men, all women. A lot of people that know me tell the story. When I took over fixed income, I had 22 direct reports, all of them men. And I reorganized the division down to 6 direct reports, which means I gave 6 men much bigger jobs, which means any women, were shoved even lower. And I had somebody come in and say, this is a meritocracy. You know, why is this happening? Anyway, I'm not going to divert. It was an incredible session that we had in a meritocracy. Why do you have this state of affairs? But my observation at managing teams, and I'm very passionate about it, is diversity. Not all women, because all women teams, I think it's a different kind of hell, but diverse teams. If 52% of the gray matter of the world is female, which it is, you can't exclude that and expect an optimum outcome. But in addition to the gender, I think I was born and raised in Greece. I have a very unique approach to a problem, not better, not worse, than a guy from Ohio and a gal from India. So to me, diverse teams that come to a problem with a very ecumenical point of view is what gives you the better answer. So I think some of that data might speak to that point.
I completely agree. I mean, I myself also from Belgium, and being from a small country, we were a little bit even smaller than Greece. I know what you're talking about. You know, you're advisor to Ripple, the CEO of Ripple, and it's sort of well known that Ripple is sitting on a huge pile of cash, and it's sort of looking for, you know, where to go with blockchain technology. You know, I'm just, what's your thought? I mean, you know, they've been very successful with the interbank transactions model. And of course, that's one distinguished application for which they really created a market. What else is out there? What do you think would be the sort of bet for a company like Ripple?
Well, look, I think they chose a space, the cross-border payment space, high volume, low value, not the Morgan Stanley, Goldman Sachs space. The one that addresses, it's a multi-trillion-dollar space, by the way. $200 adds to a lot of money.
Yeah.
But you're talking about 1.7 billion unbanked. 1.7 billion people don't even have a bank account, no matter how small the account is. And another 2 billion people underbanked.
Right.
So they chose a space that said, not only do you have people outside of the financial system, and XRP being used as the bridge currency, because it was designed for that, is a multi-trillion-dollar problem that if I solve it, I make a lot of money, I being Ripple, but also I make a difference. And frankly, the reason I am so excited to work with that company is they can change the world. So that's their mission. They're not going to, it's very expensive, by the way, to have railroad tracks that reinvent the way cross-border payments are being done. So they're lucky to have a balance sheet for such a worthy goal. Having said that, look, I used to be an options trader. Options are wonderful things to have, provided they're not too expensive. They understand that the ecosystem is being built, you know, exchanges that are worthy of that word, as opposed to fly-by-night exchanges in the middle of nowhere. So they are putting some money in that optionality of, if that infrastructure gets built, it has two things. One is it legitimizes the space, and also you're making money on your investment. But I would say they are very smart in the way they're going about these options, but their main mission, where the money is being spent, is really laying down those railroad tracks that are very important. And no one, I mean, frankly, as I said, they can't pretend they occupy Bitcoin. They are store of value, just like Bitcoin is, obviously. But they're the clear winner currently in that cross-border, the clear winner. And that's why, as I said, though, I also say they could be the Netscape of the world, or they could continue to be Google from day one to where they are today.
Indeed, indeed.
Maybe it's time for us to, let me just look at some of the questions in the chat. My friend, Kem Harvey, a friend and colleague at, let me read his question. We recently had a risk-off realization with the COVID crisis. In March, the stock market plunged, and so did gold and Bitcoin. Cryptos dropped 50%. When things calmed down and sentiment changed to risk on, equity markets went up, stocks, gold, cryptos. What does this influential observation tell us? Aren't these just risk assets where there was no hedge? So that's a first question. Why don't we take that one first? Right. So, COVID, it's the perfect laboratory for, bad outcomes. And there was nowhere to hide, sort of.
Right, exactly. So if you take the horizon of 0 to 6 months or 0 to a year, let's say, they were as risk assets, speculative vehicles, as frankly, Tesla at 800 P is a speculative vehicle. No different. I feel the crypto world in the frame that I'm putting it, year 1 to 5 years out, is equivalent to the value investor who is dying a slow death and saying, one of these years, my long-term horizon is going to work. And value investors look at not the next 6 months. So that's how I separate the horizon and how we evaluate these. That's why this idea of looking at correlations versus portfolio right now, I think that's nonsense. That doesn't work for the reasons we just talked about.
Another question is, can we talk about governance tokens? I mean, we touched on them very briefly with the smart contracts that are linked. So these governance tokens that are linked to fintech innovations like MKR, Comp, it seems like they should be treated differently from pure speculative assets like Bitcoin. So that's the regulatory side, but what's your thought about those governance tokens?
I don't know enough to give you a thoughtful answer, to be honest with you, but I would beware of uses of nomenclature that vest you with some kind of a credibility to bilk, if you will, the unsuspecting. I think governance should be part and parcel of any company in any space. I don't know that you need a different coin to actually express that. But as I said, I don't know enough to really, this was just my gut reaction to it.
Sure. You suggested a 1 to 5% allocation to cryptos early on in our conversation. That's a huge range, depending on your assets under management.
Exactly. Exactly.
How would an investor decide where to be in that range? What kind of portfolio analytics would a PM run to make this decision? And on a related note, how do you estimate the upside versus the downside probabilities of these bets? I mean, I've looked at correlations between, I know that you want to stay away from correlations, and you want to sort of be more like the sort of upside over longer horizons. But, where would you recommend a person who is more in a traditional mindset of, hedging and correlations across different asset classes, and where would you put them between the 1 and 5%, which can be a huge difference?
So first of all, I would look at who I am in terms of my net worth, like you say, and for me, if you are barely making ends meet, and you have some some assets to, there is value to sleeping well at night. So to me, if 5% of whatever it is you have, you're starting to not sleep well, that's too much, no matter what probabilities you assign to it. Because for me, as I said in trading, when I was managing traders, even if you assign 0.01% probability to a scenario and you bankrupt Morgan Stanley, the position is too big. So that's how I would think about it. If you're sleeping like a baby, maybe 1% is too small. So it's you. What is your risk appetite based on, you should not put yourself, if you have 3 kids to feed, in a position where you can't feed them. Having said that, if you're the kind, you have no obligations, and you say, you know what, if I am wrong, I don't care, I'm going to sell my house and my car and I'm going to live in a tent, 10% might be appropriate for the moonshots. So that's how I look at investments, not just crypto, but traditional investments as well. I value sleeping well at night. In my career, basically, since I guess I saw fortunes being made and lost, for me, sleeping well at night is an important thing. I work because I want to, not because I need to. So to me, that dictates how you should be approaching investing in the world. What's your risk appetite for change in life? In terms of the cryptocurrencies, I would look more like the internet world. So let's say you decided back in 1997, all these cool companies were coming up, Internet Explorer and blah, blah, blah. You know, how much can I afford to lose to a business plan? You had these people being given money on a business plan, you know, not actually executing on a business, just a business plan. And the right call was, again, within that profile, how much money, and within that, I would do the analysis the same way, which is looking at why is Google, that just announced in 1997, they're going to get into that space. And I would look at, again, the industry risk. Within that industry risk, what are the people chomping at the bit at the Internet Explorer or whatever the... So for me right now, is Ripple is the clear winner. What do I need to see to make sure they stay that? Are there others that are coming behind? Bitcoin. And overall, the one thing I would say, the risk that you can't handicap is quantum computing. I mean, most people that know anything about it, and I know exactly 0, if not less than 0, they say that's a long way off and there'll be antidotes to the problem. But if it's not a long way off and that 51% attack becomes an easy peasy thing, everything I've said, you need to forget about.
Actually, you know, I do a lot of research on quantum these days. It's still, it's one of these moonshot research. I mean, it's something that is probably, I don't know how many years I have left in my research career. It's probably not the best investment. If I were a young person, that might have bigger payouts, but I just love the topic. I was going to end by announcing our next webinar, which we run a webinar series on quantum. This is ongoing, and there's the next one is going to be in 2 weeks actually on dynamic portfolio allocation. But quantum is indeed a big unknown right now because of the entire cryptography, which is the underpinnings of the blockchain security, the trust that we have. Is in the, if we can crack those algorithms much easier, and we will be able to do that in a foreseeable future, actually, if given what's going on in terms of the technology evolving with quantum computing. It's a really serious problem, not only for crypto assets, it's an obvious problem for crypto assets, but also all the document safety, the encryptions
of documents. It will scare the hell out of financial institutions. It is known that people are just saving documents right now because they know that in a couple of years they will be able to uncrypt them easily. That's a totally different chapter to talk about, but it is an important topic that I think people in the financial industry, some of them are very aware of it and are getting prepared for it, but there are still a lot of who are not, and that's sort of,
First of all, I would love to be invited to that because, but what I would say is the way the Google executives talk and others talk about auto-driving cars.
yeah.
It's a great story, and it will be a great story for another decade, if ever. In fact, a very serious man said, if ever.
Right.
And I look at that world, and as I said, I'd love to be invited, where for purposes of what we're talking about, both the governments and the research itself is a long way off, is what I'm hearing from people that know something about. So
yeah, I agree. But you know, self-driving cars and all that is a much more complex problem than the cryptography problem, which is more relevant here for the conversations. In any event, I think we're kind of running out of time. I had a great time talking to you, and you know, when this pandemic is behind us, I hope that we can have another meeting face to face and continue this conversation. To close, I would like to say that we resume, since we ended up, that was not really planned, or talking about quantum, we will have a Rethink Labs quantum seminar on September 23rd. That's a continuation of our series on quantum by Roman Oros, who is actually going to talk about a dynamic portfolio allocation problem with real data on a quantum machine. And so mark your calendars. The information is on the Keenan Institute Rethink Labs website. Again, Zoe, this was a wonderful conversation. We covered a lot of things, and I really appreciate it. Thanks for being with us today.
Thank you for the invitation. Thank you very much.
Our pleasure. Bye-bye.